Thank you for joining us for this week's episode of HECM World Weekly. Reverse mortgage professionals watching now know that it's not just getting a reverse mortgage, but how it's structured that can make a world of difference for the borrower. And that leads me to a recent column I found in the Mortgage Reports, which is entitled, How to Choose the Right Reverse Mortgage Payout Method. Typically, that payout method is determined after the reverse mortgage professional and the homeowner consult, and they come up with a plan that best meets their long-term needs. So let's dive in. They address the financial flexibility that a reverse mortgage can create in retirement, but add that how you choose to receive the proceeds is an important decision. Your payout method affects your long-term borrowing costs, how much equity you preserve, and how useful those funds will be over time. And with a HECM, you can receive funds in a variety of ways, either as a lump sum, monthly payments, a line of credit, or a combination of those. So understanding how each of those particular payout methods works is important so you can find the best payout. They note that a home equity conversion mortgage or HECM allows the homeowner to receive funds either as a lump sum, monthly payments, or a line of credit, or a combination thereof, what I like to call the hybrid plan. And understanding how each of those works will help you to select the best approach for your long-term needs. So let's dive into the fixed rate HECM, which is typically the transaction you're going to see on a HECM for purchase because all the funds are being utilized upfront for the purchase of that home. Then they come in with the cash required for the remaining down payment. And that gives them the security of knowing that their interest rate's not going to increase over the life of the loan. The lump sum payment is the only option with such a fixed rate HECM. You receive your funds at closing, and most borrowers use that to pay off an existing mortgage if they have a high mortgage balance to cover major expenses or to pay off high interest debt. What they do omit is the HECM for purchase, of course. Lump sum provides immediate cash and the certainty of a fixed interest rate. This was one of the major drawbacks of the standard fixed rate HECM, which is no longer with us. Now, that required that a lump sum be taken, even if the borrower needed $5,000, $10,000, $15,000, they had to take all available funds to get the standard fixed rate HECM. This was prior to the reverse mortgage reforms that were enacted in 2013. So that created a host of issues for many and early consumption of the loan proceeds, and it also caused the loan balance to accelerate considerably. Of course, the line of credit is the most flexible payout method available with a HECM. You can draw funds as needed, and what remains in that line of credit continues to grow each month based on that month's current rate plus the ongoing mortgage insurance premium or FHA insurance. So let's say the average rate or the rate for a given month is 6%. That means the principal limit or available funds in the line of credit would grow at 6.5%. And that can make a significant difference over time. They put together this very useful table for the different payout methods so you can compare how it works, what's best for, and the pros and cons, which I think is a very useful tool for the homeowner or consumer. But here's where the column gets a little interesting, and I'm going to point out something they fail to mention. It says, if your needs change, you may be able to refinance into a new reverse mortgage with a different payout structure. Refinancing, that is refinancing your HECM, allows you to switch from a fixed rate lump sum to an adjustable rate line of credit, increase your borrowing capacity if your home value has risen, or adjust your monthly income stream. I would say cash flow, by the way. However, refinancing comes with new costs and requirements, so it's important to weigh those benefits carefully. But let me point out, you do not have to refinance an existing HECM to change your payment plan if you're already in an adjustable rate. Now, for those that are presently in a fixed rate HECM and want to switch to an adjustable for the benefit of the flexible line of credit or 10-year or term payments, that's fine, but that may be an unlikely scenario unless their home has appreciated significantly in recent years, which is the case for many. But with the fixed rate HECM, those balances, again, are accelerating much more quickly. So that would be a challenge. So there's no need for a refinance to change your payment structure. So to wrap this up, it's not necessarily just the amount of cash that a reverse mortgage or HECM may offer, but the flexibility it can introduce into a retiree's life and managing their cash flow. And with that in mind, structuring the HECM at the beginning is one of the most pivotal decisions that you and the homeowner will make. It wasn't too long ago that we heard the strategy touted over and over again in our industry about the benefits of postponing one's Social Security benefits and bridging that gap during the waiting period with proceeds from a reverse mortgage or a HECM line of credit. But is that always the best decision? And that is a question that is addressed in AOL. Now, it doesn't point to reverse mortgages specifically, but it does hold some lessons for you as a reverse mortgage professional today. The column's entitled, "You Should Probably Stop Waiting Until 70 to Claim Social Security." That's a little contrarian. Here's the math that will open your eyes, but no one likes to show. Put simply, it seems that the best way to optimize your retirement income is to delay taking Social Security until age 70, but is that the best choice? In fact, there's a growing consensus amongst financial professionals to say that waiting till age 70 often is not the best choice. According to the Social Security Administration, taking your benefits as early as possible, that is age 62, could result in lower monthly payments. But at age 67, which is the full retirement age, or FRA in Social Security speak, you qualify for full benefits. But if you delay your benefits until age 70, you could get a 24% boost in your monthly payouts. But that delay strategy comes with its own particular set of risks. The common advice amongst the financial planning community for years has been to delay benefits as long as possible until age 70, but that advice overlooks some math variables that could be a shock for some retirement planners. Age 70 is not the most financially rewarding age to initiate benefits unless an individual has a low discount rate or is confident they will live several years past their life expectancy, says an article published in the Journal of Financial Planning by two experts. The discount rate, by the way, is the expected average rate of return that tells us the present value of future payments. It's used to decide if it's worthwhile to wait for Social Security. And that column in the Journal of Financial Planning says it very clearly. The calculations do not support the presumption that the vast majority of those who choose to start their Social Security before age 70, they are not making a mistake. I'll repeat, they are not making a mistake by not waiting till age 70. And here's why. While recommending delaying benefits until age 70, academics and economists use simple and generalized assumptions, but they don't fully reflect the reality of most. And that's according to Derek Tharp, a financial advisor and associate professor of finance at the University of Southern Maine. In another article published in the Wall Street Journal, Tharp argues that the simple spreadsheet calculation assumes that future dollars are worth almost the same as today's dollars. Seems like they overlooked inflation. And that assumption is based on another assumption, that retirees are investing mostly in ultra-safe assets that earn little or no returns after inflation, maybe 1 or 2%. Now, today, the current rate of inflation is just about 3%. Most people don't have portfolios consisting of assets that earn just 0 to 2%. Rather, their portfolios hold a mix of stocks and bonds, which historically have earned closer to 5% above inflation, he wrote. The difference isn't a matter of trivial academic assumptions. Assuming you earn about 5% rather than less than 2% on Social Security income, that can completely change the math. It makes delaying benefits much less attractive. And during that deferral period, the retiree will be drawing down from their accumulated savings or retirement investments to meet their living expenses until they turn 70. But there's another risk, and this is one that I've always harped on when it comes to postponing Social Security. And it's this, the mortality risk. In other words, if you wait too long to collect, the house may win. Tharp notes that life expectancy in the U.S. today is about 78.4 years, according to the CDC, but an individual's lifespan may vary greatly. So if you have an individual in poor health, it really wouldn't make sense for them to wait until age 70, would it, to collect Social Security? Now, here's why this matters for the older homeowner who has substantial home equity. And it's this. Retirees are deriving their income from a variety of sources. Social Security, investments, could be bonds, real estate, even the sale of a business. But you may be gambling with your own financial future because you can't predict when later becomes too late. In other words, if you die before you begin drawing those benefits because you chose to postpone them, then yes, the house wins and you lose. Now, one very important point I want to drive home today to you as a mortgage professional, and it's this. Steer clear of advising an older homeowner whether or not they should postpone their Social Security benefits. Because if you do, you're treading into dangerous territory where you are giving advice outside of your expertise and license, and that can open you and your lender up to legal liability. You don't want to go there, but instead, you can encourage that homeowner to meet with a Social Security planning specialist who can determine the best strategy to maximize their benefits and look at the entirety of their situation, including their current health and their life expectancy. So there you have it. Waiting till age 70 may not always be the best choice. Recently, I came across a column in Housing Wire, which is targeted for the traditional or forward mortgage originator, but it holds some valuable lessons for us as reverse mortgage pros as it relates to marketing, and it's entitled, "Stop Marketing Like It's 2008, You're Invisible." Okay, you have my attention. So let's dive in and see what lessons we can glean. Mortgage marketing is stuck in 2008. Not because the tactics are old. We have webinars instead of lunch and learns, sponsored posts instead of postcards. The problem isn't outdated tools, it's an outdated mindset. The fact that most of us never really learned how to market in the first place, which would imply that the methods used in 2008 were ineffective as well. So why are mortgage professionals still using them today? One example they give is setting up a booth at a realtor appreciation event. Your third one this year, you paid $2,500 for the booth or table. Many drift by, you have 3 actually stop, and 1 takes a koozie without even making eye contact with you. Yes, welcome to the world of conventions or exhibit booths. In such cases, one may justify their efforts and expense with brand awareness. Yes, I'm building brand awareness, and I'll do it again next year. So this is not an outlier, says Housing Wire's column. It's just how the industry still operates, quietly and routinely. Now, following the housing crash of 2008, many mortgage professionals and, of course, realtors really emphasized getting referrals from other professionals in their areas or previous borrowers. That became kind of the mother's milk of their business, but they didn't really invent themselves, or reinvent themselves, I should say, any more than that. It got quieter, but they were doing the same things. The loudest voices drew scrutiny, the flashiest lenders collapsed. So the industry built systems that kept everyone safe behind layers of approval, compliance reviews, and corporate marketing, which can tend to sound just like everyone else. And those systems are still running 17 years later. And yes, the compliance is real, but somewhere along the way, it stopped being a safeguard and became a shield for mediocrity. Today, lenders still fund the same activities, realtor lunches, branded postcards, appreciation events, not because they work, and this is an interesting point, but because it's what mortgage marketing has always looked like. It feels safe, it feels familiar, but it may be completely ineffective. Adding, if you ask 10 loan officers what marketing means, you'll get the same answer. I just need more leads. That isn't a strategy, it's desperation dressed up as demand. And when it comes to social media posts, they say that everyone's struggling to be seen, but no one is being discovered. Interesting point. Someone could make a simple video about DTI or debt to income ratios in 90 seconds, and in that process build more trust in 90 seconds than most lenders earn in a year. So what can be done differently for mortgage professionals, and yes, even for reverse mortgage pros? One is to focus on answering real questions. That is, what are the people out there that are considering a reverse mortgage or a traditional mortgage really thinking about? What decisions are they grappling with? This builds trust by being useful instead of pretty. It creates demand instead of waiting for referrals. And it sounds like someone you'd reply to, not a committee trying to not offend anyone. And by committee, they mean the marketing approach that most mortgage lenders continue to use today. One of the key points made in this column is to show up where those decisions are being made by potential home buyers, and I would add potential reverse mortgage borrowers, because what most of us call marketing really isn't marketing. It's the appearance of marketing. Again, it's not about being louder, it's about becoming more relevant than your competitors to really attract the business. So put yourself in the mindset of the potential reverse mortgage borrower. What are they stressing about? What are they fearing? What are some of the decisions that they're grappling with today? And if you address those, if you look right into the psyche of the potential reverse mortgage borrower and you focus on that like a laser, your marketing efforts will be much, much more effective.